Every single day, trillions of dollars move through the stock market. It's a massive global system, yet most people don't really know how it works. Today we're breaking it down in plain English. No confusing jargon, just clear facts. By the end of this video, you'll understand what stocks are, how people make money from them, and how you can start investing, even if you only have a few dollars. Let's dive in and demystify the stock market together. Stock is simply a tiny piece of ownership in a company. When companies need to raise money, they sell pieces of themselves. These are called stocks or shares. If you buy a stock, you become a part owner of that company. It's a way for businesses to get funding and for individuals to participate in their growth. Imagine a company as a big pie, and buying a stock means you own a slice of that pie. This concept is at the heart of the stock market. Companies sell stocks to raise money for expansion, research, or other business needs. By offering shares to the public, they can access funds without taking on debt. Investors, in turn, get a chance to share in the company's future success. This mutual benefit is why the stock market exists. It connects businesses needing capital with people looking to grow their money. The process is straightforward, but the impact is huge. Stock market is a marketplace where people buy and sell ownership pieces, stocks. Prices change based on supply and demand. More buyers push prices up, more sellers push prices down. Major exchanges like the New York Stock Exchange and NASDAQ are where most trading happens. These platforms connect millions of investors and companies, making the market dynamic and constantly moving. Stock prices are driven by supply and demand. If more people want to buy a stock, its price goes up. If more people want to sell, the price goes down. This simple principle is the engine behind every price movement in the market. Understanding this helps you see why prices fluctuate and how you can potentially benefit from these changes. New York Stock Exchange, NYSE, and NASDAQ are the two biggest stock exchanges in the United States. They host thousands of companies and millions of investors. These exchanges provide the infrastructure for trading, ensuring transactions are secure and transparent. Knowing where stocks are traded helps you understand the global nature of the market. Bull market is when stock prices are rising and the economy is doing well. Picture a bull charging forward. That's the energy of a bull market. Investors are optimistic and companies are growing. Historically, bull markets last longer than bear markets, which is why long-term investors often see profits. Understanding bull markets helps you spot opportunities for growth. Bear market is when stock prices are falling. Imagine a bear swiping downward. That's the feeling of a bear market. Investors become cautious and companies may struggle. Bear markets can be tough, but they're a normal part of the cycle. Knowing about bear markets helps you prepare for downturns and make smarter decisions. Bull and bear markets are opposites. Bulls charge forward, pushing prices up. Bears swipe downward, pulling prices down. Both are natural phases in the stock market. Recognizing these cycles helps you make better investment choices and avoid panic during downturns. Historically, bull markets last longer than bear markets. This means that long-term investors almost always profit even if there are short-term drops. Staying invested and not panicking during downturns is key. The stock market rewards patience and consistency. There are two main ways to make money in the stock market: price appreciation and dividends. Price appreciation happens when your stock rises in value. Dividends are regular cash payments from some companies. For example, if you buy a $10 stock and it rises to $15, you've made a 50% profit. Both methods can help you grow your wealth over time. Price appreciation is when the value of your stock increases. If you buy a stock at $10 and it goes up to $15, you've made a 50% profit. This is the most common way people make money in the stock market. Watching your investments grow is rewarding, but it's important to remember that prices can also fall. Dividends are cash payments some companies make to shareholders. These payments are usually made quarterly and represent a share of the company's profits. Not all stocks pay dividends, but those that do can provide steady income. Dividends are a great way to earn money even if the stock price doesn't rise. Over the past 100 years, the stock market has returned an average of 10% per year. This means that, on average, investors have seen their money grow steadily over time. While there are ups and downs, the long-term trend is upward. Investing early and staying consistent can help you benefit from these returns. You don't need a lot of money to start investing. Many platforms allow you to begin with as little as $1 using fractional shares. This means you can buy a small piece of a stock even if you can't afford a whole share. Starting small is a smart way to learn and grow your investments over time. Platforms like Fidelity, Vanguard, and Robinhood make it easy for beginners to start investing. These platforms offer user-friendly interfaces and educational resources. You can open an account, deposit a small amount, and start buying stocks right away. Choosing the right platform is important for your investing journey. Fractional shares let you buy a portion of a stock rather than a whole share. This is perfect for beginners who want to start small. You can invest in big companies without needing hundreds of dollars. It's a flexible way to build your portfolio and learn about investing. The most important thing is to start investing early. Small amounts invested now can grow significantly over time thanks to compounding. The earlier you begin, the more time your money has to grow. Don't wait for the perfect moment. Start today and let your investments work for you. Compounding is when your investment earns money and then that money earns more money. Over time, this snowball effect can lead to significant growth. Even small amounts can become large sums if you invest consistently and let compounding do its work. Investing in the stock market involves risk, but it also offers rewards. Prices can go up or down, and there's no guarantee of profit. However, by understanding the basics and investing for the long term, you can manage risk and increase your chances of success. Diversification means spreading your investments across different stocks and sectors. This reduces risk because you're not relying on just one company. If one stock falls, others may rise, balancing your portfolio. Diversification is a key principle for smart investing. Before you invest, set clear goals. Are you saving for retirement, a house, or just looking to grow your money? Knowing your goals helps you choose the right stocks and strategies. Investing is personal, and your goals will guide your decisions. Always research before buying a stock. Look at the company's performance, industry trends, and financial health. Good research helps you make informed decisions and avoid mistakes. Use resources like company reports, news, and educational platforms to learn more. It's easy to get emotional when prices rise or fall, but successful investors stay calm and stick to their plan. Avoid making decisions based on fear or excitement. Focus on your goals and the long-term picture. There are many resources to help you learn about investing. Online courses, books, and videos can teach you the basics and advanced strategies. Take advantage of these tools to build your knowledge and confidence. Subscribing to finance channels gives you regular updates and tips. Weekly videos can keep you informed about market trends and new opportunities. Staying engaged helps you become a smarter investor. Don't be afraid to ask questions about investing. Whether it's online forums, finance channels, or professionals, getting answers helps you learn and make better choices. The more you ask, the more you know. Regularly review your investments and progress. Check if you're meeting your goals and adjust your strategy if needed. Reviewing helps you stay on track and improve your results over time. Consistency is key in investing. Regular contributions, even small ones, can add up over time. Stick to your plan, keep learning, and let your investments grow. The stock market rewards those who stay committed. You've covered what stocks are, how the market works, bull and bear markets, ways to make money, and how to start investing. Remember, the most important step is to begin. Use the resources available, set your goals, and start your investing journey today. See you in the next video as we continue to explore personal finance together.